Hello, everyone. Welcome to the Money Counts webinar series presented by the Sokolov-Miller Family Financial and Life Skills Center. If we haven't met yet, I'm Melanie Schramm, and I am an education program specialist at the center. I will be hosting our webinar series every other Tuesday throughout this semester. We come together twice a month for an hour to cover important money topics with the goal that you would leave feeling more comfortable, more confident, and more capable of making smart money decisions that support your financial future. I'm also joined today by Haley, one of my colleagues from the center, who will be sharing out some helpful resources and information to you all through the chat box. So thank you so much for joining us today for webinar number 3 in our series on saving and investing. If you need to step out early, it's no problem whatsoever. We are recording the session today, and it will be posted on our YouTube channel by the end of the week. You'll find all of our other past webinar recordings there as well. So Haley, if you could send over our YouTube channel for everyone, that would be great. We will be back again in 2 weeks on March 3rd to talk again, this time about financial decluttering. So mark your calendars, and I hope to see you back. We will discuss cleaning up your money so it feels simple and clear and under control instead of messy and overwhelming. I do want our time together today to be interactive, so I want to test out some of the emojis with you. If you can take a second to quickly find the emojis on your screen, and if you've attended a past webinar with us before, hit the thumbs up emoji. If this is your first time here with us, go ahead and hit the heart emoji. Oh, wow. I see lots of new faces today, lots of thumbs up, lots of hearts. Awesome. Welcome back, everyone. We're so happy you're here. If you are a part of the SMEAL Ethical Leadership Challenge, you don't have to do anything other than just stay tuned in. You will automatically receive your credit when I submit attendance. If you are not familiar with our center, I just want to quickly share a little bit about who we are and what we do. The Sokolov-Miller Family Financial and Life Skills Center is Penn State's hub for personal financial resources. Beyond our webinar series, we offer so many other free services to support your financial well-being. Our website is a great starting point for tools, resources, and information about what we offer. Haley, if you could drop our website into the chat, please and thank you. One of our biggest services that we provide out of our office is one-on-one financial coaching. Students and alumni can meet with us for free about any financial topic, and we also offer public service loan forgiveness meetings for faculty and staff members. We offer presentations for classes, clubs, and organizations on topics like credit cards, identity theft, salary negotiation, and more. We have self-paced study modules on all of our financial topics that you can locate on our website and work on any of them at any point in time, and it's all anonymous. We also have bookshelves throughout our Penn State campuses where you can find some reading material on various financial topics. And it's not textbook type of books. They're actually really great normal teaching books that you can learn from. If you happen to be at University Park, our office is in the Grange building right next to the hub, and you're always welcome to stop by and grab a book at your, if you feel like that would be a good reading tool for you. Through our partnership with PNC Bank, you also have access to additional coaching and financial education opportunities. So they are always an avenue that you have access to. I'm really excited to get into saving and investing today. This is a really exciting topic for me, but I do quickly want to go over some logistics just so we can continue being interactive throughout the session. I do have the Q&A box open, and I will be keeping an eye on it. Haley is here with me as well, and if she can answer any of the questions, she will. We will save some to answer throughout and then save some hopefully for the end. But I will take the time to pause throughout to answer questions as time allows. And if you have noticed already, we do have some of the resources already being shared out in the chat from our team throughout the webinar. So keep an eye out for those. Before we do move into the elements of financial wellness, I want to give just a quick overview of what my goal is that you can leave today feeling better about. And just a quick note, this is all for education purposes. This is not personal financial advice. By the end of this session, my hope is that you'll understand why saving and investing really matter, no matter your age. That's a really key thing, no matter how old you are. You'll see compounding, can help your money grow over time. You'll get a clear picture of account options such as retirement and some other investment accounts. We'll look over the basics of stocks, bonds, real estate and funds. And then most importantly, my goal is that you feel empowered and ready to either start a saving and investing plan or improve what you already have. So just keep these takeaways in your mind as we go along today because everything will tie back to these. As I mentioned earlier, our biweekly webinars are designed to give you the knowledge and tools to navigate financial challenges and opportunities and improve your overall financial well-being. Financial well-being is about having financial security and the freedom to make choices, which means you're able to pay your monthly bills, maintain an emergency fund for unexpected expenses, and still have the freedom to enjoy your money while staying on track towards your financial goals, again, at any stage of life, and doing these all at the same time. At the center, we like to use this visual of this ladder to show the steps toward financial wellness. 2 weeks ago, if you joined us for our webinar on budgeting, we focused on that very foundation, starting out with a budget. This week, we're looking at some of the steps that follow after you have that budget solid and secure. Saving and investing isn't just one of these steps. Rather, it's built into each of them. Across these stages, saving and investing helps us build up our emergency fund, pay down debt strategically, plan for the future, and grow our wealth. As we dive in today, you can think of saving and investing kind of like a thread that runs through your entire financial wellness journey. I would like to see what's on your mind. Don't overthink it. Just type out the first word or phrase that comes to your mind for each of these. Saving is blank, investing is blank. Ooh, that's a good one. Saving is immediate, investing is long term. Very good. Saving is easy, investing unknown. Okay, good. So for me, sometimes saving is complicated and investing is risky. We're going to jump in and talk about saving. And it isn't just about holding on to your money and keeping it. It's really about building a foundation for yourself as well as creating options. When you give yourself options, you're really giving yourself freedom. And it's the kind of freedom that makes financial wellness exciting and worth striving for. Your saved money gives you choices, and those choices, maybe it's pursuing a passion, taking a trip, or finally telling your boss, okay, I'm done, I'm out. You saved up your money and you can finally say, I'm doing this on my own terms, and I'm not worrying about it. A fun way to think of this is kind of as freedom money. It's savings that gives you the confidence to make decisions without that added stress. And it's also important that we save for practical things. If your car breaks down, you have your savings that you can rely on. The once a year registration payment comes due and you forgot about it. Well, hopefully you have that savings there so that you are covered. For me, I personally like to travel. So that savings is really helpful for me when I can travel around and get outside and do my things that I enjoy. And then my husband and I are also currently looking to improve our quality of life by purchasing a home. So if you want to share out anything of what you would spend your money on that would make your life easier or more enjoyable, just to kind of have in the back of your mind what goals you're working toward as we talk about saving and investing today. So just if you want to send over a word or sentence or a phrase about what you would spend money on that would make your life easier or more enjoyable. Yes, someone said a car. I love that. Yes, car would definitely help being able to make life easier, more enjoyable. Vacation, especially as the weather gets warmer. Yes, future expenses, living costs, knowing that financial future is secured would definitely provide peace of mind. There is a very big mental aspect of finances, and definitely having that sense of safety and security is amazing. Someone said moving somewhere warmer. A lot of friends have been talking about that lately. The snow is getting to us all. Family planning, vacations, spending money. Oh, definitely. Someone mentioned a medical expense that came up and needing to budget for paying those sorts of things down the road. Very good. Yes. Home improvements, peace of mind about retirement, paying off student loans, college with kids. Yes, absolutely. Paying down that credit card. Good. So we're all kind of in a lot of different spots in looking at our goals and why are we saving and why are we investing. But it always helps to have that in mind that you're working towards something. Saving really does give us that freedom and helps cover all that practical stuff too. And we really just want those options, the security, and the chance to enjoy life along the way. Thank you for sending over your responses, everyone. I appreciate that. So, we're going to talk now about some compounding interest, which is one of the most exciting benefits of saving and investing. If you have heard of compounding interest before, give me a thumbs up just so I can get a feel of where we're at with that. Awesome. A couple of you are sending over some thumbs up. Yes, great. So on the screen, you can see a QR code. And just to make it a little bit more visual for you, NerdWallet has a compound interest calculator that you can play with it and see how your money can really compound over time. Oh, heard of it, but didn't understand the risk. Yes, we are definitely going to be talking about risk today and how you can work with that. When we save our money in a bank or a credit union or invest in the market, we earn interest, and compounding is what really takes it to the next level. So, compound interest means that you're earning interest not just on the original money that you invested, but you're also earning interest on the interest along the way. So, this is how you put your money to work for you so that you can earn more. A simple example, let's say $100, you deposit $100 into an account that's earning 5% interest. At the end of the first year, you would have $105. So that extra $5 is the interest. By the end of the second year, you would then have $110.25 because now you're earning interest on that $5 that added in extra from the last year, too. Compounding is definitely not super exciting when you're first starting out in year one. When it gets exciting is year 20, for example. So, using $100 as a simple example really helped keep the math easy. And if you would put that $100 away and earn 5% on it for that 20 years, that would turn into about $265. Imagine though, if that investment, the original amount that you put in was $1,000 or $10,000. Your percentage would stay the same, say 5%, but those dollars are compounding and getting bigger. That's really where the magic lies. Your money starts multiplying faster over time, and you're adding zeros and zeros and zeros onto the end there. Here I have another example. Say you decide to put $250 in today, and then every month you continue to add another $250 across the time span of 30 years in total. and the amount that it would be earning in interest is 4%. So over time, you would deposit $90,000 in total, but your interest would earn almost the same amount, just a little bit less, around $84,000. Adding your original investment plus your interest would give you a total of right around $174,000. And that's why we call it the magic of compounding interest. Keeping your money under your mattress doesn't do much. I know a lot of people often have that coin jar at home that every time you maybe have loose change, you put into your coin jar. And there's no shame there. Absolutely not. But if you would take that money and put it into an account or invest it to earn interest, you're allowing it to grow for you instead of it sitting there and not working. So where exactly do we get this compounding magic? We're going to talk here about some accounts. If you were with me a couple weeks ago for our budgeting session, this bucket might look a little bit familiar, and I'll talk about some different pieces of it today than I did 2 weeks ago. There really are so many great tools out there that can help us save. And I know that across our mix of students, staff, faculty, alumni that we have here today, some of you might already be using some of these, and some of you might be hearing them for the first time. Either way, it's knowing your options is what's important. When saving, we can look at some different options, such as savings account, just traditional savings accounts. There's high yield savings accounts, and then there's money market accounts. They're usually fairly easy to open. There might be some minimum balance rules, but the big win at the end of the day is that they can earn you interest. High yield savings accounts typically pay higher interest rates than standard savings accounts, and that's why people choose to use these for their everyday banking. That's why people choose to keep their everyday banking in one place and then have a high yield savings somewhere else. So, for example, for me, I have some of my money right into my normal credit union, but then I do have a lot of the most of my money into a high yield savings account. So being able to split and keep track of money in two separate accounts. But just keep in the back of your mind that the higher percentage, the higher interest rate is always going to equal more growth over time. And it's good to be picky and compare rates and shop around so that you can find what will work best for you. You have choices and you can absolutely use them. And then if your banker, your your bank or credit union is insured, your money is protected, which is much safer than having it under the bed or dug in a hole in your backyard. So having that sense of security that your money is safe in your bank, definitely it helps you feel more comfortable. One of my favorite tips is to automate your savings, and this could be done by setting up recurring transfers from one account to another, say a checking to a savings account. There are options for you if you want to do it weekly, monthly, whatever would work best for you. And setting up those automatic transfers takes the pressure off and turns savings into a habit. For me, I think of it as set it and forget it, but I also do go back and revisit and check to make sure that those amounts still fit within my budget. If there would be any sort of life changes, I'm making sure that I always have enough money that's going to transfer. One of the easiest ways for me to remember revisiting my transfers is whenever a pay increase comes around, usually about once a year. And this is a time that I then take that extra money to transfer it to my automatic savings on that reoccurring transfer. Depending on where you are in your financial journey, a solid starting goal would be to aim for about 3 months of your essential expenses for emergencies. And you want to start wherever you are. Progress always, always, always beats the waiting around for the perfect timing. Mindset shift that I can appreciate is being able to think of savings like this visual bucket that you can see on the screen. Every dollar being saved has a purpose, it has an intention. Some of those dollars are going towards short-term goals, some of those are going towards upcoming expenses, and some of them, of course, for that emergency fund that you don't want to touch unless you really need it for your medical bills or if you have to get your car fixed, for example. This is how you can really get your saving to start working for you. I want us to take a pause here and just ask ourselves a really big question. Will saving alone be enough? We have to think, will it be enough for retirement, for buying a house, for weddings, kids, building wealth, maybe even leaving a legacy someday? Earlier, when we talked about what our goals were for saving money, many of you talked about these things. So if you can just give me a quick gut check with a yes or a no, send it over. Will saving alone be enough? Yes, there's a string of no's right off the bat. Exactly. And I'm pretty sure that's why everyone is here today, so we can discuss some of those ways because saving money is usually not enough. Someone said, I have tried and it hasn't been getting me very far. Yeah, good. So we can look at some different strategies to kind of work with that. Excellent. Yeah, thank you for that. So yeah, why? Well, we feel it every day, and it just so happens to be inflation. Inflation quietly eats away at what money can actually buy over time. And when looking at some of those big life expenses, it really shows up. Some of the homes in the US, mid $400,000 on average. Weddings, some people are spending $30,000. Raising a child before college would easily top $200,000. So all of these different expenses, the big life expenses, the inflation is showing up within those purchases. And retirement, when we think about that, people who are retiring today, we're looking at them needing $1 million dollars or more. And again, that's in today's dollars minus any inflation and increases and things that we will be seeing over time. So just to reflect a little bit about this, I think for myself, I hope to retire somewhere between the ages of 60 and 65. But really, we're going to see once the time gets closer. I still have a little bit until I'm there, but I'm thinking about it. And that's the important thing. And I hope that you all are thinking about it as well. So for me specifically, women in the US live on average to 81. If I live that long and retire at 60, may need to afford my life without working for about 20 years or more. So during that time, I'll need some sort of income. Some people live even beyond age 81 into their 90s or 100s. And no matter what age people are living to, it's still a good chunk of time to need an income while not working. Some of you might not have that goal to retire early. Maybe working part-time or full-time into your 70s and 80s is something that you're interested in. And regardless, planning out for the future that we want is important. And no matter what, that future that you're planning is going to cost money. So if you're curious about how inflation impacts savings, we do have an inflation calculator. Haley, if you could drop that inflation calculator. She did drop in the Bureau of Labor Statistics, the inflation rate, and that did just come out for January, but they update it usually about every month. Um, but that inflation calculator, just a fair warning, it can feel a little depressing at first, but it is fun to play around with and just see because it is reality and it helps us to know what's real. Even though, like I said, it can feel a little depressing. It really does help us to answer The next more important question, though, how is it that we beat inflation? So, this is where we're going to start shifting a little bit more into investing and using our money to grow faster over time. We will soon get into those nuts and bolts of investing, but I do want to talk a little bit more about why inflation reduces our purchasing power over time. When we ask ourselves, will saving alone be enough? There's a lot that we have to think about. We have the APY, which stands for annual percentage yield, and it's the return that you get on your money sitting in a bank account or invested in the market. And then we also have inflation, which right now it's just a little bit over 2%. If your money is earning less than inflation, you're actually losing your purchasing power over time. Even if your account balance is going up and you do see that number growing, the cost of everything around you is growing faster. So that dollar that you have is simply not stretching as far as time goes on. Right now, traditional savings accounts average around 0.39% APY. Haley, if you could drop that national rates and rate caps from FDIC, but 0.39 on just your traditional savings account is pretty average. Some people are getting less, and I am. My traditional savings account is 0.05%. I'm okay with that though, because I really enjoy the institution I bank with, and most of my money is saved out in other savings accounts that are earning more for me with higher interest rates. So I've been able to still appreciate the institution that I've been with for many, many years. Often people are curious about high yield savings accounts. So if anyone is familiar with what a high yield savings account is, if you could just send over the party hat emoji, just so I can kind of get an idea of where you're at with high yield savings. Okay, a couple, not a whole lot. There's a couple there. Good, excellent. So with those high yield savings and money market accounts, you can be more intentional about where you're housing your money and getting it to work for you. The Federal Open Market Committee, which is the arm of the US central bank that makes decisions about managing the nation's money supply, they aim to keep inflation right around 2% across time. Right now, we are at 2.4%. So we are close to that inflation, the goal rate. We've all lived through a lot of these ups and downs with the inflation spikes. We've felt it, groceries, gas, housing. If you can remember, just recently, eggs were costing $7 or $8 a dozen, sometimes more. But we do feel that inflation. And so the biggest takeaway with all of this is that we don't want our money simply to just grow. We want it to grow faster than inflation. And so that's where our investing comes in, so that we can have those tools to help our money outpace inflation over time. Haley, if you could drop, there's an inflation calculator so that you can see the impact of savings. I'm going to have her drop that in the chat for you. And it's, again, a nice tool that you can just kind of play around with, plug in some numbers and try it out to see specifically the impact of savings with inflation. Planning for the future. If you're saving your money, and just to be clear, savings set aside that aren't for your bills or your short-term goals or your emergency funds, any other saved money, that's where you can start taking that and it could become your investing money. So you built that capital first by saving it, and that's the step one that really matters. If you're working your way up this financial ladder and you're ready to move into investing, this is where we're going to start talking about how to do that. If you're not quite there yet, that's still okay. It's really helpful to know and be able to understand that. So there's something that we often say at the center, and it's do something today that your future self will thank you for, because we know that the future will be very expensive. And the best thing that we can do is start by taking action today, even no matter how small and just little by little. It's the important step is just starting and taking action. Being intentional with saving and investing can lead to more security, flexibility, freedom, and honestly, more peace of mind. I've had a couple of you bring that up today, just having that peace of mind. Later, also, again, because we have all ages with us today, later can look very different for everyone with us. Maybe it's 5 years or 10 years or 25. No matter what, again, the goal is just taking that first step and moving forward. So when we say do something for yourself, for your future self, this is what we mean. It's save early, save and invest early and often, as long as you can. And I am going to show you why. On the screen, we have three scenarios with three different people who are investing their money. We have Talia, Jess, and Nate. If you can just take a look over the three of these people who are investing their money and let me know who you think is going to end up, with the largest investment balance by age 65. So you have Nate, who has invested 5,000 a year for 40 years, starting at age 25. Jess has invested 5,000 a year for 10 years, also starting at age 25. And then Talia has uh, invested 5,000 a year for 30 years, starting at age 35. So if you could quick type and send over who you think will have the most amount of money by age 65. Okay, I'm getting a lot of Nates. Yes, you are all very quick to figure that out. Yes, so Nate is the one who will end up with the most. Each of the three of these people made the same exact yearly investment, which was that $5,000, but their timelines are different. And so his 40 years of investing did provide the largest return. Now I want you to tell me who comes in second after Nate. Do we have Jess or Talia? So Nate he made over $1 million across his 40 years investing. So this is where it gets interesting. Yep, I'm getting mixed responses. There's some Jess and some Talia. It definitely gets interesting here. Oftentimes we would think that it would be Talia because she invests more money in total, but it's actually Jess. Even though she invested $100,000 less in total than what Talia did, she started 10 years earlier. And so there's where we have that extra time to let the compounding work its magic. So again, the key is the earlier you start, the more consistently you invest, the more time compound growth has to work. And that's where those big long-term returns come from. And if you're sitting here thinking, oh, this is great, but I'm 35 or 45 or 55 years old, keep in mind that you are not out of the game and you're not even close to being out of the game. Starting later just means that you might be investing more aggressively or more consistently, or even reaching out to get guidance like free financial advisors through your retirement plans. And honestly, doing that is smart at any age. The key takeaway is so simple. It's just the time plus consistency plus the compounding gives you that opportunity. Time and compound growth are working together. Now we're shifting into long-term, long-range investing, meaning retirement. Retirement is expensive. We've talked about this, and it's one of the biggest financial goals that most of us will ever have. At the end of the day, what we're really trying to for saving for retirement is building what we would call the replacement income, which is the money that pays our bills whenever we decide that we're done working. Most of us do think about that moment where we can sit back, we can kick up our legs and say, okay, I'm done. I'm retired. I'm ready to enjoy my life, the beach house, the backyard, the dogs, the grandkids, whatever retirement, whatever your dream of retirement is looking like for you. And so, how is it that we get there? For many people, it starts off with the employer sponsored retirement plans, such as a 401k or a 403b. One of the biggest perks of being in the workforce is that employers often do help us save for retirement. And sometimes they even match what we contribute. That match that they offer is essentially extra money being added into your investment account from your employer, which is huge for long-term growth. If you are here at Penn State, you have resources like TIAA, SERS, or PSERS, depending on your retirement plan. Those organizations offer free financial advisor appointments, and it's absolutely worth using them so that you can understand what's happening with your money. And I also want to talk to everyone, not just if you are employed at Penn State. Some of you might not have a job. You might not be offered an employer-sponsored retirement plan. That's where we start looking at the IRAs, which is your individual retirement account. Anyone with some sort of earned income can open one. And there's two main types. There's the traditional IRA and there's the Roth IRA. The main difference between them is that they have different tax advantages that we'll look at here in a second. But something that a lot of people don't realize is that while retirement accounts are meant for retirement, there are some IRS exceptions for early withdrawals. So one of the big ones within an IRA is a first-time home purchase. And we talked earlier how home prices are rising. They're averaging near $500,000 in the US. So the idea of saving money in a retirement account and being able to grow that money through compounding and then being able to use that money to put towards a first home can be very powerful. So keeping in the back of your mind that retirement accounts aren't just about the old you. They can help support major life milestones along the way. Looking a little bit deeper into the Roth and traditional IRAs, I want to break down the tax advantages because this is, again, where the accounts differ. And you get to decide Roth, traditional, or both. And the choice really comes down to when is it that you want to pay those taxes. With a Roth IRA, you contribute post-tax dollars, meaning you get your paycheck, your taxes come out, and then you invest what's left. That money grows and compounds over time. And here's the win. When you withdraw that money in retirement, you don't pay taxes on it. You've already paid those taxes up front. Roth IRAs can be appealing for people early in their careers because if you're in a lower tax bracket now, you may be paying less tax today than you would later in life when you're earning more. And then we have the traditional IRA, which works in the opposite way. With the traditional IRA, you contribute your pre-tax dollars, and doing so lowers your taxable income today, which could lower your tax bill. Your money still grows, it's still compounding over time. When you go to withdraw that money in retirement is when you pay the taxes on it. So again, looking at your Roth versus traditional IRAs, the question becomes, do you want a tax break now or do you want the tax break later? And I can't answer that question for you, but a financial advisor or someone else could help walk you through that. And keep in mind that you don't have to pick just one forever. Some people do use both depending on what their goals are. These accounts exist to help you grow your retirement savings faster. And if you are with me today and you're in your undergrad or grad school, you don't have to wait until you're working full time to start. Any sort of income from a part-time job does count, and you can start investing for your retirement in an IRA right away. Like with Nate earlier, you might be thinking, yeah, I don't want to wait. I'm ready to start now. I'm ready to take advantage of the time and compounding. So we will talk about now how you actually invest. So we're getting into the nitty-gritty here. How is it that we invest? Let's say you've picked out an account. For this example, we'll just stick with an IRA. And the basic flow of it would be first figuring out how much to invest or contribute. Then you open your account, you pick your investment mix based on your risk tolerance, and over time, you can adjust these as your life or goals change. Logistically, it's not complicated, but sometimes taking that first step is where we get stuck. So, what this could look like for you is download an app, open an account, pick investments, and then check in and make updates over time. It's just a few clicks. That's really all that it is. But the other side of it is feeling confident in your choices. And that's a whole different conversation. But the process of actually just getting it started is so much more accessible than what a lot of people tend to think. And you do not have to be an expert whatsoever to begin. You just have to be willing to take those first steps to get started. With the IRAs, your individual retirement accounts, we can think of them as folders where investments live, such as your stocks, your bonds, your real estate. They're all held inside of that IRA. But here's the thing. You don't just walk up to a bank and say, okay, I want to open an IRA. And you can't just go into your phone app store and type in IRA. There isn't an app called IRA. What you would need to do is find a brokerage app or a financial advisor to open one. So if you could think of that as step one, as getting your filing cabinet, which would be the app or your advisor. And then step two would be opening that folder, which is the IRA. So breaking down these options, you have full service brokers who offer investment advice, research, trade execution, and portfolio management. You get guidance through them on hands-on support, but keep in the back of your mind that you will pay some higher fees because of those services that you're paying for. Discount brokers are apps that let you buy and sell stocks, bonds, and funds. These tend to have lower fees and are simpler to use. You'll find yourself often managing your own investments or utilizing a robo-advisor, which is an AI tool that guides you after a quick survey about your goals and what your risk tolerance is. You have your financial advisors who you can sit down and meet with and talk with face to face with the real people who can help you with your investments and your overall financial planning. You get personalized advice for your budget, saving for college, any sorts of big goals, but over time you will be paying a larger fee for these services. And if you do look into a financial advisor, checking their credentials is important, such as seeing if they are a CFP, CFA, different things like that, because these people have a fiduciary duty, meaning that they are legally obligated to act in your best interest. So you want to make sure that they have one of those credentials because it's huge when you're trusting someone with your money. So even though it might sound a little bit confusing or complicated, it doesn't have to be. You can make it as simple as you want it, and that would just be searching a brokerage app in your phone, checking out different reviews, different fees, different features, and picking one that you could actually use and feel comfortable understanding, and something that you can see yourself sticking with over time. Personally, for my investment accounts, I utilize both the web version and the app version. But again, you get to decide what works for you. And of course, you need to get your ducks in a row in order to open an account. You'll need your social security number, your home address, and identity verification, just the basics to get that account open. So once you take this step, you can congratulate yourself because you have taken the first big step. And keeping in mind, though, after you congratulate yourself, be ready to take another step. Often people get tripped up that once you put your money into your IRA, you have to move your money then, because it doesn't mean once it's there, it's invested. You would then have to go in and choose your investment mix. So you open up your IRA and then you get in to invest, whether it be stocks, bonds, real estate funds, or even alternative investments like crypto, if that's what you're interested in. This is where your money starts working for you. If you just leave it sit there, you drop it in there and don't invest it, it's basically doing nothing, which is worse for me than that 0.05% interest on my savings account, because at least I have access to that to spend it. But if it's sitting in your brokerage account, it's frozen until you invest it, and you want to make sure that you put it to work. Looking at bonds, when you buy a bond, you're basically lending money to a government or a company, and in return, they promise that they'll pay you back with interest. Bonds are lower risk, and you can see the risk meter down at the bottom, because specifically US bonds have historically been considered very reliable, making them a fairly safe bet if you want some steady, predictable income for short or medium term goals. One of the downsides is that bonds generally do offer out lower returns than what stocks or real estate do, so they will definitely not make you rich overnight. But bonds are definitely a smart piece of your portfolio, especially if you're more risk adverse and want to balance out some of your higher risk investments. Next up, we have real estate, and investing here can look different. It can happen in a few ways. You can earn money through rental income if you own property, or you could flip a property and make money when it appreciates in value. Full-on property ownership does require a lot of upfront cash, which isn't always feasible for everyone, which is where we look at REITs then, your real estate investment trusts. These let you invest in big commercial or residential properties without buying a building or a home yourself. So you can think of it as buying shares in a company that manages a portfolio of real estate. Your REITs are a great way to help diversify your portfolio without needing that added stress of mortgage, tenants, or maintenance. And we have individual stocks. Buying a stock means owning a piece of a company. Historically, stocks return about 10% per year on average, which after that, about 2% of inflation, you're roughly gaining about 8%. Stocks can be volatile, which with prices swinging up and down, and that can definitely feel stressful. But if you're in it for the long haul, stocks can be really powerful wealth builders. And the key behind them is maintaining that patience for your long-term plan and also diversifying. I do want to take a little bit of a deeper dive into individual stocks. Again, if you buy a stock, you're buying partial ownership of a company that can offer strong returns over time. As we've seen lately, stocks value can fluctuate dramatically. And so they're very much ideal for long-term investments and for the investors who are comfortable handling those ups and downs. They can certainly be emotionally challenging to manage when the market is especially volatile, which is something that we've seen recently. We're in a time where the market is experiencing some uncertainty, and this is a normal part of the investing cycle. It doesn't signal a crisis, but it does underscore the importance of having a long-term plan and building some of that diversification so you can weather these periods of time. If I want to invest in companies, but I want to lower my risk so I'm not putting all of my eggs in one company's basket, say if the company fails, I don't want to lose my investment. So instead of picking individual stocks, you could invest in something called a fund. Funds are your friend. There's mutual funds, index funds, ETFs, target date funds. These are collections of investments managed by the professionals. Most are aiming to mirror the performance of the stock market, which would be that about 8% in return. Some funds are actively managed that would cost a little bit more because professionals are actively picking and choosing them to try to beat the stock market returns. Know that having these in your portfolio is a great way to diversify because of the mix of stock, the mix of companies, as opposed to just one. Think of it kind of like making sushi at home versus going to a sushi master. You could do it yourself, but a pro already knows what works. Funds spread your risk across those many companies so that you're not betting everything on one stock. And for beginners, looking into funds is a fantastic way to start investing without feeling overwhelmed. And finally, we have alternative investments. These are outside the traditional categories, such as cryptocurrency, NFTs, commodities such as gold and silver, or even collectibles such as Pokemon cards. And having some alternative investments can diversify your portfolio and offer potential returns with a higher risk. They're also less regulated and can often be complex. I want to now hit on the risk tolerance. Your risk tolerance is key, and you have to ask yourself, how aggressive or how conservative do I need to be? While looking at the time horizon, looking at your financial goals, and looking at the market conditions are all important pieces here. Your investor profile is something that you can generate through some surveys. Haley, if you could drop, she did drop there. We have two different risk tolerance assessments that can guide you so that you know where you're at. And younger investors often have more time to ride out market swings, but your personal profile, not necessarily your age, should guide your choices. So when we look at each of these, sitting on the left, on the more conservative side, you see this profile has a significant portion in bonds with some in stocks and some in cash. But then as we continue to move to the right, we see more aggressive profiles. The breakdown changes to less bonds and cash over time. We also see more stocks. The majority is stocks, and then also some of those alternative investments. Just a quick reminder, we are here to help. All of our services are free for students, staff, faculty, and alumni. And again, if you work here at Penn State, we can assist with public service loan forgiveness. And just keep in mind that you also have access to representatives from PNC, TIAA, SIRS, and PSERS. I hope that you're able to take this information from today and move in some next steps with confidence in your saving and investing journey. I cannot wait to see you back again in 2 weeks on March 3rd for financial decluttering.